All right. Did you want to start with your opening remarks or?
Yes, I'll go ahead and get started. Welcome, everyone, and thank you for attending today's hearing. I am Joy Hatchett, the Acting Commissioner of the Maryland Insurance Administration, and this is the Maryland Insurance Administration's third regular public hearing in 2024 regarding the specific carrier rate increases for long-term care insurance. Today's hearing will focus on two rate increase requests now in the individual long-term care market before the MIA for review. These requests are from Allianz Life Insurance Company of North America, and they have proposed an average rate increase of 29.80%, varying by benefit period for policyholders on forms 10PQ-MD. And then we also have a request from Continental Casualty Company proposing an average increase of 156.8%, varying by inflation and benefit period for policyholders on forms P1N0080A19, P1N0086A19, P1N0100A19, P1N0081-A19, P1N0095-A19, P1N0101-A19, P1N0085-A19, and P1N0096-A19. And those numbers, if you had missed them, are actually a part of the notice. So you can go back to the notice and actually see those notices. We were previously going to include a rate increase for Genworth. However, we have determined that we're going to defer the hearing on that particular matter until approximately December 18, 2024. So we would ask that you just take a look at our website and you will find the specific date for that hearing. Now, the two requests that we are reviewing today basically impact approximately 2,969 Maryland policyholders. The purpose of the hearing is for the insurance company officials to explain the reasons for the rate increase and for the MIA to consider whether the proposed rate increases are in compliance with Maryland's laws and regulations relating specifically to long-term care insurance. We will also listen to comments from consumers and other interested parties. We are here to listen. We at the Maryland Insurance Administration, Brad and his team, will ask any questions of both the carriers and the consumers regarding these particular rate requests. Now, let me just take a couple of minutes to introduce the team from the Maryland Insurance Administration who are going to be presiding today. We have Brad Bobham, who is our Chief Actuary, and Jen Shin, who is our Senior Actuary. And then also Craig I, who's our Director of Communications. Now, let me go very quickly over a few procedural things that are important for today's session. Basically, what we're going to do today is we're going to call on have the members of the insurance companies make presentations and give information regarding their filings. And individuals from the MIA will have the opportunity to ask them questions. Those questions are only going to be coming from members of the MIA. The public is not going to have the opportunity to ask the members of the carriers any particular questions. We will also keep the record open. So if there's something that you'd like to communicate as a member of the public, you will have until Wednesday, October 2nd, to submit any written questions, information, or anything else that you would like the MIA to consider. We are also going to post this video on our website. And if you just go to the website and look under consumers, you'll see a link to long-term care, and that'll lead you directly to this recording. We ask that you listen, keep your cameras off, and if you're speaking, please put your cameras on so we can actually see who's speaking. And now I'm going to go ahead and let the carrier start. Brad, before we had the carrier start, did you have anything that you wanted to add?
Yeah, I have a few brief words actually. I just want to, reiterate that all the products that we are reviewing here today are guaranteed renewable products. A guaranteed renewable product is a product that the carrier must continue to renew for as long as a consumer wants to pay the premiums. But it does allow for premiums to be increased, which is why we are here talking about the rate increases. It allows premiums to be increased either across the board for a policy or for a rating class of policyholders, such as those who have limited benefits versus those who have lifetime benefits, or those who have an inflation rider versus those who do not have an inflation rider. So, unlike other healthcare products, long-term care products are more like life insurance in that it has a long-term life projection that needs to be made when the rates are initially set. So carriers were projecting for 40 years worth of claims and premium. And just like life insurance, the premiums are collected throughout the life of the policy, but the claims happen at the end of the policy. So carriers are forced to project cash flows and to make sure that, they have enough premiums set aside in reserves from the early years when premiums are exceeding claims. They need to reserve those for later years so that when the claims come, they have enough money to pay. So this creates a large amount of uncertainty when setting the rates, this 40-year long-term projection. And one thing to know is that when these policies were priced, it was believed across the industry that the premiums would be sufficient to cover claims. These products were filed in all 50 states and were reviewed by regulators across the country. And at the time, given the life insurance data that carriers were using to price things, they had no reason to believe that they were underpricing. But in retrospect, the claims have turned out higher than expected for a variety of reasons. First, we have actual investment earnings turning out a lot lower than was anticipated, meaning the premium reserves have not grown as fast as planned. On the claim side, we have a lot more members who are utilizing benefits than originally anticipated, both because mortality rates and lapse rates have turned out to be significantly lower than carriers assumed. Third, we have the cost to utilize benefits has grown faster than expected, as both the number of days per disability as well as the cost per day have come in higher than projected. So the combination of all of these assumption misses compounded over a 40-year time frame is that premiums have been set significantly too low, in many cases multiple times lower than claims. The MIA is statutorily charged with ensuring that rates are neither excessive nor inadequate nor unfairly discriminatory. So we need to walk a fine line. We do not want any insurance companies to become insolvent. And so we need to make sure the carriers have enough premiums to pay claims. But we understand how large these increases are being requested. So, my team gives a lot of scrutiny to each and every rate increase. On average, the MIA approves a little over 1/3 of what is requested over the last 5 years in this long-term care market. And I just want to, let you know that each and every filing is reviewed with the same level of scrutiny, no matter how many policyholders are in a particular product. So with that, Joya, I'll turn it back to you to call on the carriers.
Thanks, Brad. So I think we're first going to hear from Allianz. So if their representative could introduce themselves and go forward and give your presentation.
Hi, I'm Scott Laska. I'll be speaking on behalf of Allianz today. Hopefully you all can hear me.
Yes, your audio is good.
Okay. Great, thank you. Yeah, I'll get into our written statement and then happy to field questions after the fact. Well, my name is Scott Laska and I'm a long-term care actuary at Allianz Life Insurance Company of North America, and I'm in good standing with the Society of Actuaries and the American Academy of Actuaries. Thank you to Commissioner Hatchett and the rest of the MIA for reviewing our filing and having this hearing today to give us the opportunity to discuss the considerations that went into our request. We understand rate increases are difficult for our policyholders, along with insurance departments who are trying to balance the impact on their constituents with maintaining a strong private market for long-term care needs. We are requesting a rate increase on our Generation Protector product under policy form number 10PQ-MD. This product was sold in Maryland from 2004 to 2007. This rate filing would impact around 623 of our 1,480 Maryland policyholders. We are currently requesting an average rate increase of 30%. The level of the rate revision varies by the policy's benefit period. This rate increase is a follow-up to the most recent rate filing approved on October 14th, 2021, where the rate increase level approved was less than the initial request. The current rate increase proposal is comprised of the remainder of the 2021 request in Maryland for each benefit period that was not approved, and is consistent with the approach taken in jurisdictions that approved less than their initial 2021 requests. This form is in need of additional premium rate increase due to past and projected future experience that continues to be more adverse than previously expected and originally priced for. The current premiums are unreasonably low in comparison to the benefits provided. A rate increase on this policy form is needed to reduce the losses on this business. In the interest of balancing the needs of policyholders and rate equity across jurisdictions, we are requesting premium rate increases averaging 30%, which is much lower than we could actuarially justify. By lowering the requested increase from what is justified, we anticipate sharing in the losses of this business. We understand that this request is greater than the required annual cap of 15% in Maryland. We would like the opportunity to work with the MIA to phase in the rate increase over multiple years at no more than 15% per year, so we can be more transparent with our policyholders regarding our increase plans. If the full requested rate increase is approved and implemented, the company currently does not intend to request any additional rate increases on these policy forms unless experience worsens. We will guarantee not to increase the revised rates for 4 years. If the requested premium revision is granted, the total rate increase approved in Maryland would be in line with the average total rate increase approved on this policy form nationwide. The average premium levels after the requested increase on this policy form is lower than the average premiums of long-term care policies sold in the market today. It is important we offer and communicate to policyholders multiple options to reduce the impact of the rate increase if they're unable or unwilling to pay the higher premiums. Among their options, policyholders can reduce their benefit period or benefit amounts, cancel their benefit increase rider, or lengthen their elimination period. We communicate these options in several places in our rate increase mailings and encourage policyholders to call our dedicated contact center to better understand their options. Our contact center has access to various resources to illustrate policyholder premiums and benefits under different coverage scenarios, along with access to a cost of care website. The cost of care website provides average LTC costs across the country so policyholders can make more informed decisions about how much coverage they'll need. I encourage any affected policyholders to access the cost of care website and to call our contact center for any assistance with understanding the options that are available. We're offering additional benefits to our policyholders as part of this increase as well. Those who choose to reduce or cancel their benefit increase riders will maintain all of their past accrued benefit increases to date. Additionally, we are offering a free paid up benefit for policyholders who decide to stop paying premium because of the rate increase. Rather than losing their entire coverage, policyholders who stop paying premium as part of the rate increase will get a reduced paid up benefit, typically equal to the premiums that have been paid into the policy. As we considered the impact our requested increase would have on our policyholders, we wanted to know that policyholders would still find value in their insurance after the requested increase. In addition to premiums being lower than long-term care policies sold in the market today, we looked at policyholder behavior around our recent rate increase implementations. In our experience, the vast majority of policyholders impacted by a rate increase have decided to maintain their current benefits and pay the increased premium, which is in line with experience across the industry. Nationwide, we have seen around 11% of policyholders elect to reduce benefits on recent rate increases, and around 2% decide to stop paying premium altogether. This indicates to us that policyholders still see value in their Allianz long-term care insurance to cover future long-term care needs that can be very costly and deplete retirement savings quickly. And once again, I'd like to thank you, Commissioner Hatchett and the MIA, for giving us the opportunity to discuss the considerations that went into our rate increase request. I look forward to working with you on finding a solution that balances the needs of all stakeholders. I'd be happy to take any questions too.
Thank you. Brad, did you have any questions for him?
Yeah, thanks, Scott. I have a couple questions. So you mentioned that this is a follow-up to a 2021 filing. And so is it correct that you haven't updated any assumptions since that 2021 filing? You're using that the same set of assumptions. It's just the remainder of what hasn't been received from the prior approval?
So we did actually update our assumptions since the last filing, with mostly offsetting impacts as far as like changing our incidence assumption in one direction and our continuance and utilization assumptions in another direction. So it had a very small impact on like the projected lifetime loss ratios. But we did update assumptions, and this filing is using the updated assumptions.
Okay, so you do have some updated assumptions, but they're generally minor changes that are offsetting, and the loss ratio is coming out close to the previous one.
Yep.
All right, thank you. And then you mentioned the benefit if a subscriber does not pay, they're going to get a paid up non-forfeiture option. Is that accurate?
Yep, that's right.
And that's at no cost to them, right? And then that's something extra that you guys are just including.
Yep. Yeah, it's similar to like the kind of the guidelines or the NAIC like benefit, but we're offering it for free, and without like the substantial increase trigger. We lay out in our policyholder communication too, like there's a limited time to it. Policyholders have like 120 days to make the election, but we spell that out in several places in our letters.
But you say you only expect 2% of subscribers to take that option?
Yeah.
All right, and that is included in your modeling of your lifetime loss ratio projections, the assumed buy downs to both other reduced benefit options and to this NFO?
Yep. Yeah, in section 15 of our ACT memo, I believe we have our assumption of the assumed benefit reduction percentages that were in our modeling. And then, yeah, we actually assume a 1% shock lapse too in our lifetime loss ratios, just presuming since this is a follow-up filing, we typically seen the reduced paid up elections happen more frequently the first time someone sees an increase. So.
Okay, thank you.
Yeah.
One more question. So you mentioned a 4-year rate freeze after if we were to approve this, you would freeze rates for 4 years. Is that 4 years from the end of the rate action, or does that include like when we have multi-year rate actions? Is it gonna, if it's 3 years of rate actions, are you saying you're not going to change rates in the 4th year?
Yeah, we've typically done it where it would start from the start of implementation. So yeah, if it was a 3-year stage, it would be I guess, 4 years from the start of implementation that we would guarantee not to increase rates.
Okay. Thanks for that clarification.
Yeah.
But that 4 years would only come into play if something material changing your assumptions, right? You said unless you're not looking for more based on the current loss ratios, but
That's
if the
right.
assumptions change and the experience worsens, correct?
That's right. Yep.
All right. Thanks. Those are my questions. Jen, did you have any questions?
Yeah, Mr. Laska, your rate request was higher for the longer benefit periods because your loss ratio and deteriorating experience is more severe for the longer benefit periods. I would expect the same thing, but is it always the case? Is it always normal to have a higher loss ratio for the longer benefit period policyholders?
Yeah, that's what we've seen for as long as I can remember. Yeah, it's been that way. Yeah.
Do you think it comes from initial pricing that longer benefit periods were more likely to be underpriced compared to lower benefit periods?
Yeah, I think that's a major component of it. And then I think when we've updated our assumptions too, I think we're just seeing, yeah, a bigger disparity on the higher lot or benefit periods. Yeah, since we're seeing just higher utilization to begin with, but it's kind of compounded the longer the benefit periods are.
Right. So your actual to expected the gap is greater for the longer benefit periods.
Yeah, I guess I would assume so. I could double check for sure, but that's my expectation. Yeah, given the lifetime loss ratios we're seeing.
And what would you say is the most significant contributing factor in deteriorating loss ratio generally? Is it voluntary lapse or mortality, interest rate lower than what you expected? What would you say is the most significant factor in the high developing loss ratios?
Yeah, in this filing too, we laid out, I think, also in section 15 of our memo that we don't look at changes in interest rates as a component of the loss ratios. We just assume for this policy form a 4.5% valuation rate. So
Okay.
the deterioration in our loss ratios here is really driven by our changes in morbidity primarily. And like I would say within that, like incidence rates being a lot higher than we expected, and continuance rates being higher than we expected, to primarily being like the main drivers within like our morbidity assumptions.
Yeah. And also, would you say that attained age of the Maryland policyholders are higher than national average or lower than national average?
I don't think I have that right in front of me. So I can try to follow up with that.
Yeah. Because I would expect if you have a higher attained age for the Maryland policyholders, there will be obviously more propensity to, create or, have claims in the future, right?
Yep. And so we'll add that this request and the loss ratios that we used to justify this request was based on nationwide experience. So while we do look at Maryland only experience, yeah, we definitely don't want to we want to base the request on what we're seeing nationwide. So.
Right. Okay. Great. Thank you.
And to clarify, the experience is nationwide experience adjusted to the Maryland premium history, right?
Right.
Not just unadulterated national experience.
That's right. Yeah. Thanks. Yeah. Yep.
Okay. All right. Just wanted to make sure that I'm interpreting these loss ratios correctly.
Yep.
I think that's all the questions we had, Joy.
Thanks so much, Brad. And thank you, Mr. Laska. So now we'll turn it over to Continental Casualty. And if you could introduce yourself.
Yes, thank you, Commissioner Hatchett. Hello, everyone. My name is Saira Makhani. I'm an actuary and a director on the long-term care and force management team at CNA Insurance. I'm in good standing with Society of Actuaries and American Academy of Actuaries. To the Maryland Insurance Administration team, thank you for giving CNA and our policyholders an opportunity to discuss the recent filing of Continental Casualty Company, which is the principal underwriting company of CNA. For some context, CNA is primarily a property and casualty insurance company, and long-term care represents approximately 5% of CNA's net written premium in 2023 and about 39% of total reserves as of year-end 2023. CNA today does not actively write new long-term care business. However, CNA has almost 350,000 policyholders nationwide and approximately 11,500 in the state of Maryland, including all our individual and group long-term care business. This is a substantial and important book of business, and the company is committed to actively manage the block for our insureds and fulfill our obligations towards them. As others on the previous calls have discussed, the long-term care industry at large made assumptions when these policies were originally sold some 30 years ago. CNA also, like other long-term insurance carriers, used certain assumptions when originally setting the premium rates. These assumptions use the best available information at that time about a variety of factors, including the expected lifespan of policyholders, the number of insureds going on claim, the length of time insureds would be on claim, and the cost of receiving long-term care services. These assumptions were best estimate of future experience for these policies at that time. Unfortunately, actual experience developed differently than originally expected. More policyholders are utilizing long-term care than expected, and cost of care is much higher than expected. While the reasons for CNA's rate needs are not unique in the industry, we believe we have a responsibility to actively manage the block and fulfill our obligations towards our insurers. In order to do so, we must continue to seek actuarially justified rate increases where the need is greatest. To explain what I mean by where the need is greatest, we are seeking higher rate increases requests on policies with richer benefits where the experience is significantly different from expected, specifically policies with unlimited lifetime maximum benefit along with AIB riders. The rate increase request in this filing varies by benefit features and automatic increase benefit AIB rider. Policies without AIB riders are not part of this rate increase request at this time. I would like to briefly discuss these two key features by which the rate increase request varies. First, the benefit feature. Having an unlimited lifetime maximum benefit on the long-term care policy means that if, in the instance, a policyholder do go on claim, the policy will continue to pay the benefits for as long as they received qualified care, regardless of how long it may qualify for these benefits. There are options to reduce this benefit feature and thus pay lower premium for the reduced coverage. Secondly, the automatic increase benefit rider. Having an AIB means that your daily maximum dollar amount you could potentially receive in care will automatically increase typically by 5% each year to cover the cost of inflation. For instance, if an insured has earned 5% inflation benefit per year for the life of his or her policy, he or she may find that the benefits are sufficiently inflated at this time. In this instance, an insured may elect to drop the inflation rider and would receive a substantial decrease in their premiums while maintaining their accumulated inflated benefits. The policyholders with lifetime benefit or inflation riders have the option to reduce their coverage to a lower benefit or drop AIB riders which in turn mitigates the rate increase. Now moving on to our submitted rate filing. CNA currently has one open filing with the state of Maryland as part of nationwide rate increase program on individual long-term care product named Preferred Solution. Preferred Solution policy forms were originally issued between 1998 and 2003. There are approximately 3,200 active policyholders in Maryland under these policy forms, out of which 2,300 have policies with AIB rider and will be impacted by this rate increase. Overall rate increase request impact is 156.8%, ranging between 40% and 263.3% for policies with AIB rider, varying by benefit feature. The highest rate increase requests are on policies that have both AIB rider and unlimited lifetime benefit. The lower rate increase are on policies that have AIB rider with limited lifetime benefits. To understand these rate requests more, it's important to look at the lifetime loss ratios for both of these cohorts. As of year-end 2023, both cohorts are over 100%. And in case of AIB rider, along with unlimited lifetime benefit, it's over 150%. A 150% lifetime loss ratio means that for every dollar of premium collected by CNA, the company will pay out 1.5 times that in claims. Given these lifetime loss ratios are well in excess of 100%, CNA will continue to absorb the vast majority of the financial load associated with these policies going forward, including paying for the expense of administering the policies. If the Maryland Insurance Administration takes corrective action now by approving the full rate ask, it will allow the future time horizon to compound the reserves, which will allow the company to request lower rate increases in the future. The longer the insured waits to pay these rate increase, the greater the magnitude. This is commonly referred to as cost of waiting. For this individual rate filing, we have submitted the full rate increase request for transparency, but understand the 15% annual limit will require further discussions with MIA on how best to implement. Now, the decision to implement a premium increase is a tough one. CNA understands how difficult premium increases can be for our policyholders. On the other hand, it is our responsibility to continue to seek rate increases that are actually justified and allow us to share the burden of this business. In lieu of rate increases, CNA offers a variety of options to help manage or avoid the increase. Available options depends on and vary by each insured's current coverage levels, benefit options available under their specific policy forms, and any statutory minimum benefit levels in your state. So say a policyholder receives one of these rate increases. What are the options we are proposing? First, if the insured continues to pay the new premium amount, he or she will continue to maintain existing coverage and no further action is needed. Second, CNA offers our policyholders the option to stop paying premium altogether on their policy and convert to a paid-up contingent non-forfeiture policy that has a reduced maximum lifetime benefit. With this offer, the reduced maximum lifetime benefit will be equal to 150% of the premium paid to date, capped at the policy's current remaining lifetime benefit. This can be used as a pool of money in case there is a need for long-term care needs in the future. Third, they can lower the current coverage in one of several different ways: by dropping their AIB rider, reducing lifetime benefits, increasing their elimination period, or other options available on their policy, and reduce the impact of this increase. It is worth noting that our insureds are able to elect coverage reductions at any time in exchange for lower premiums, not just when they are notified of rate increases. As always, our policyholders have a host of choices in the face of rate increases. We recommend that our policyholders carefully review the options as presented and call our customer service team if they have questions. We understand that each insured has a different set of life circumstances and policy benefits, and not all options may be equal value to all policyholders. As always, when considering changes to coverages, we encourage our policyholders to carefully evaluate the cost of care in their respective areas and consider speaking to their families, trusted financial advisors, and or tax advisors. Before concluding, I would like to highlight what CNA is doing to encourage the wellness of our policyholders. So, in addition to providing options for our policyholders in lieu of rate increases, we are continuing to invest in foundational capabilities which will help drive claim innovation and wellness solutions. One of our key focus areas and foundational capabilities is providing our insureds access to Wellness Portal, which will aim to educate our insureds on care options, resources, tools that support their aging in place needs. Additionally, our fraud, waste, and abuse program provides more oversight to increase identification of suspicious claims for investigation and allows us to pay for insureds that require care. CNA continues to engage with other carriers and entities, including Medicare resources, to explore the best ways to engage with our insureds and provide effective solutions for them. We have the same goal as our insureds. We want them to stay healthy, in home, and be well cared for. Policyholders with questions should reach out to our customer service number to understand various initiatives and options we have and available for their use. In closing, CNA appreciates the opportunity to discuss these rate actions. We are committed to fulfill policyholders' obligations both financially and operationally, and partnering with Maryland Insurance Administration to provide these solutions to our insurers. Therefore, we respectfully request that MIA and policyholders alike recognize that these increases are vital to ensuring that adequate reserves are available to CNA in order to satisfy future claims. Thank you, and I'll pause for any questions.
Thank you. Brad, did you have any questions?
Yes. So as far as benefit reductions go, do you have any assumptions about what percentage of your policyholders will take these benefit reductions? Especially with the very high increase, is it a higher percentage that you see buying down in states that approve this increase?
Yes, so our, we have assumptions for our shock lapse and RBO, but in terms of benefit reductions, companies is still collecting the data. So far, what we have seen is, we are seeing about 2 to 4% take up rate on these offers, which again is, goes to say that our policyholders do value these long-term care coverages and, keep up with the premiums.
Okay, thank you. And can you tell me what are the biggest assumptions that have changed since the last time you filed for this policy?
Yes, so I think it's across the industry. So our interest rate assumptions since last filing, it has not changed. For the most part, we are seeing the changes on our incidents and utilization. So cost of care is a significant portion.
Okay, thank you. Those are all the questions I had. Jen, did you have any questions?
Yes, Ms. McCarney, my question is, I know you're not including the policies without AIB riders in this filing, but I was wondering if you mind providing the experience of the policies without any riders. I'm sure they are running well. That's why you're not requesting any rate changes for those policies. But I was wondering if we can take a look at your experience on the policies without any AIB riders.
Sure, I think, yeah, absolutely. It's not part of this rate increase, but we are, we can certainly provide the experience for non-inflation. And would you like to see non-inflation split by lifetime and non-lifetime, or you just want to see it?
Yes, that would be great. Like, split the unlimited and the limited benefit periods, just like you exhibit like make it exhibit 1C through 5C and 1D through 5D. That would be fantastic.
Sure, absolutely. We can certainly provide that.
Great, thank you. And another question I have is that I noticed there's a big difference in attained average age between unlimited benefit policyholders and limited benefit policyholders. So I was wondering, it was very strange to see the limited benefit policyholders' average attained age was a lot higher than the other block. So if you can kind of confirm that your data is correct, or provide more clarification of the comparison between average attained age of the unlimited benefit policyholders versus limited benefit policyholders.
Okay, sure. I can certainly take that away as well. And are you, so just to be clear, is this just Maryland specific policyholders that you're interested in?
Maryland and nationwide.
And nation.
Yeah.
Sure. So we can certainly get back to you after double checking the attained ages by the lifetime and non-lifetime benefits.
That's right. Great. Thank you so much.
Welcome.
That's all I have.
All right, I think that's all the questions from the actuarial team.
Thanks, Brad. And Craig, I believe we have one consumer that signed up to speak.
Yes, Mr. Carter, and he now joined us on the panelist side. So, Mr. Carter?
Can you hear me?
Yes, we can.
Okay, good. I would just like to, I submitted written testimony, and if you don't mind, I'll just briefly read it. I'm a Maryland resident, and I've had the long-term care policy with both the unlimited and the AIB since for a very long time. I think it was 2000 that I got the policy, both my wife and I. I'm sorry, there were some exhibits that I was unable to find on the website from Continental Casualty. I apologize, but I wasn't able to review those. I looked at, what I typically do is I'm not an actuary, so I'm sure you're all much better at that than I am, but I typically look at Genworth. They have a website where they show national long-term cost of care trends. And so I was looking at the cost of a private room over 20-year period, and that increased roughly linearly. It's not perfect, but by a factor of about 1.8. That's about a little less than 3% compounded increase over this period of time. Just to, in context, they list the Baltimore area increase for private rooms only 1% in the last 1 year. So over the 24 years, my premiums have gone up by a factor of almost 2.9, or a 4.4% annual compounded interest. The actual increase over the last 10 years has been higher. It's about a factor of 2.5, or about 9.5% compounded annually. I know there's different assumptions, but I'm just looking at the premium. The outlays may be different, and I realize there is a difference between their collecting the premiums and how much they have. But clearly the premium increases have, relatively speaking, increased the cost of care. I will note that these policies were stopped issuing many, many years ago, 2003. So clearly the pool of insured is going to decrease. And as a function of time, it's obvious, and that must have been obvious in 2003 when they stopped this, that the logical conclusion of this is this particular pool will just face more and more, and higher increases. And I guess I don't understand why they don't spread the risk around. They must have understood it back in 2003. It doesn't sound like Continental is going bankrupt. And so I would think you would need to look at any insurance company of all their insurances in aggregate to make a fair view of the risk. Again, I think to do otherwise just means that the people in this particular pool are going to, be faced with unaffordable premiums. And I hate to say it, but I think that's a fait accompli. Just listening to this, it's what else can you do if that's the way it's viewed? So I would just like to appeal to the board, insurance commission, to not grant such large rate increases. And that's my testimony. Thank you very much.
Thank you, Mr. Carter. Brad, did you have any questions for Mr. Carter?
No, I don't think I have any questions at this point. Thank you for your testimony. I appreciate it.
Okay.
Craig, did we have any other consumers signed up to speak today?
We did not, and I don't see anyone in the chat or who has indicated they would like to speak. They could also raise their hand if they would like to.
So we'll give folks just another minute if they would like to speak today to either indicate it in the chat or raise your hand. Seeing none, just want to once again tell people that after this hearing, you have until October 2nd, when the record will close, to submit any written testimony that you'd like. Also, within the next couple of days, this recording will be posted on our website. Thank you all again for joining us today, and enjoy the rest of your day.
Thank you. Goodbye.